Assalamu alaikum ji. Thank you so much for joining us again on this exciting series of live webinars sponsored and supported by IGI Holdings. It's an honor to have all of you here as attendees for our session. I'm really honored to have a panel of experts with me from the industry who will be providing all of us their valuable inputs. But before I could sort of start off with the session today, just a few housekeeping notes. As a moderator, Mr. Sajad Iftikhar will be engaging with the panelists on all the areas of focus. The audience should submit their questions online via the Zoom messaging tool. Any Q&A session will be held at the end of the webinar, where Mr. Sajad will ask some selected questions from the panelists, obviously, and time, based on the time slots that we have. All the slides and the recordings will be shared out with all of you who have joined in, and also will be available to all our respected audience through the streaming tools that we are reaching out on. And if you, in case, God forbid, if you reach out or face any technical difficulties, which any of us can face, just bear with us in case there is an issue, on in the internet connectivity, or in your case, if there is a technical difficulty you are facing, kindly connect with Zoom Help Center to sort of move this forward. So moving on, I just wanted to sort of reflect on, just a recap. This is the second session in the series of the first batch of live webinars, that are being hosted by IGI Holdings. And the seminar or the webinar is basically on the impact of COVID-19 on the investment climate and the way forward. Today's session will primarily discuss the impact of this pandemic on the investment climate in Pakistan, including the equity market and markets and the fixed income markets, and how the people should be planning their savings under the new normal. Just quickly, we will be using this, the attached streaming platforms, starting from Zoom. We've got Facebook, LinkedIn, and YouTube as well. So without further ado, I will request our head of the investment operations in Packages Group, Mr. Sajad Iftikhar, to take the lead as a moderator and take this session forward. Over to you, Mr. Sajad.
Thank you very much, Nawan. Thank you very much. Good afternoon, and welcome you all into this session. So, as the name speaks, it's COVID-19 and its impact on the investment climate. We have been blessed that we have got very respected names of the profession as our panelists. First of all, I'll be introducing Mr. Yasir Qadri, who is CEO of UBL Funds. Then we'll have Muhammad Asim, who is CFA President and is also serving as Chief Investment Officer in one of the leading AMC's, MCBRA. And then we have before moving to the panelists to have valuable inputs, I think it's my responsibility to share what is the fact sheet around COVID-19 with the investment industry. COVID-19 is essentially a health crisis that the world has never seen in the past 100 years. It has turned into an economic crisis after the Great Depression 80 years ago, and now transforming into a financial crisis, so that all of us need to make some intervention when it comes to the policy rates to make have an impact to recover the economies. Just to give you an high view how the McKinsey have looked at things, they have just this just shows how various sectors of the industry have been impacted with this COVID-19, starting from aerospace, air travel, banks. These are the most affected areas of the economy that has been affected globally. And if we move from left to right on our screen, we can see that there are certain industries who are least impacted, like pharma and high-tech industries, where the impact was seen as low. So from these businesses to stock markets, if you look at the world indexes, the world stock markets, they have all have experienced an initial drop truly during the first quarter of the year. And if you look at all the indexes, be it Nasdaq, Shanghai, Nikkei, they have seen a downturn till 31st of March. And then there is a recovery phase coming into all, and now there is a topsy-turvy ride that all of the exchanges are facing. And like Pakistan Stock Exchange going down to like 28 to 30% has now recovered on an overall basis at 18% during the past 4 months. So starting from this KSE 100 performance, we need to look at how various sectors in our KSE 100 index have been impacted. If you look at oil and gas and banks on the left side of your screen, these are the most affected. Oil and gas, perhaps due to consumption, we'll see Asim's views, how different sectors have been impacted and what's the way forward. But if we move from left to right, we can see the pharmaceutical industry was most resilient into that situation. And cement industry has also, perhaps after the construction offtake after 15th of April, have seen certain good recovery. We'll see Qasim's view on that into our main panel discussion. Now coming to the fixed income side, like we haven't seen a fixed income side like this for the past, say, 10, 15 years, when a discount rate has been dropped down by 5.25% during a shortest period of 4 months. And an inverted yield curve is also flattening now. So we'll see Qasim's view, how this interest rate environment would look like in future. And that is the brief outlook, how the economy, how the equity market, and how the fixed income market has faced so far. With this note, I'll try to open up the session with Mr. Yasir Qadri. He's an expert in his field with over 25 years of experience, and we'll seek his view on the economic outlook. Good afternoon, Yasir.
Good afternoon, Sajad. First of all, thank you for having us over. I'll try and start with my 2 bits. We'll try and keep this restricted to economy in the capital markets context. Otherwise, it may just become too wide a subject to cover in the time that we have available here. So starting off with, as you had requested, with the economic growth. From the look of it, if we break down the GDP, into its different segments, we have a feeling that the GDP growth or the negative growth or the decline in GDP may actually be larger than what the ministry or the government is forecasting. It's probably, and I'm talking, and I will continue to talk in nominal terms here, since I feel that is more relevant for our audience here and in context of the markets. So nominal GDP, I feel, will probably decline by maybe more than 2.5%. And if you break it down, what you see is that about 1/5 is agriculture, which probably would remain the only large segment of the GDP, which would be largely unaffected or very mildly affected. But others, significant segments, would have an effect. So, and anybody could, have a different view on that. But if you just do some back of the envelope calculations, I think that's what it'll boil down to. So that's the outlook on our, the growth side. And,
so, like we are into an IMF program. Yes, sir, like we are into an IMF program and discussions are underway for the next fiscal year's target. And there is an expectation that $5.1 trillion will be the target for tax collection during the next year, which means there will be around 500 billion of new taxes coming in. Under this COVID situation, how do you feel the economy would look like to achieve these tax targets?
I mean, surely it will be a challenge. If you look at our data for the last many 20 odd years, the best we've done in terms of growth in tax revenue was probably between 2015-16, when we grew by 21-22%. We've never really done better than that, and that has effect on the economy as well. I I don't really see that happening, that target being achieved. But while we are striving for it, that may create its own challenges. It's a bit of a draw on liquidity, as we saw earlier, 2015-16, advanced taxes, sales tax, refunds not happening, and that's a draw on the liquidity of the system. So I think that will start hampering things a little, and especially if we see it in the market context. Markets are really, as I see it, to forecast markets, we need to be able to forecast two large variables. And that the two large variables are money supply and various valuations in the market. And then you break it down to, segments and to companies and et cetera, et cetera. So the outlook you create on growth of businesses and the money supply in the system or the liquidity in the system. So it is important that, the liquidity in the system is sustainable in the stock market context. If you break it down in the current situation, what we see is that here we have a much larger fiscal deficit than originally expected, which will fuel liquidity because, the various sort of stimuli packages coming in by the government. I think some of them were budgeted already. Some are incremental. So the incremental ones would probably, Asim would correct me, but it will probably be between 550, 600 billion rupees or thereabouts, I suppose, which were not originally budgeted. So that will create liquidity in the system. On the flip side, as I said earlier, if GDP growth is negative or is declining, that will have a negative impact on money supply as well. So whatever the net effect of that is, and I see that as being marginally positive, not significantly, but marginally positive, but it may have its leads and lags. So it may create volatility in that sense. And then the second part, valuations, is where you have relative valuation. So it's in absolute terms how companies are going to do in terms of their earnings growth, etc. And I think Asim will comment on that. He's a better person to comment on that, more suited. And the second part is that how, in terms of opportunity cost, how interest rates are going to behave. And then I think we'll break it up when Qasim talks about that in further detail. But really broadly, these are the things that one should be, I think, looking at. So we have seen in the past in Pakistan and globally that when there are large and unexpected and sharp fiscal deficits, usually it's not followed by economic growth. There's usually a gap in between, and asset prices tend to inflate. So there may be a scenario here where we may see, and because there's not a wide range of assets available to us, so it may be some cherry-picked stocks or some other assets. But I would not be surprised if we go into that scenario briefly. It may not sustain, but there may be a blip.
Sir, so coming from fiscal deficit to the current account situation, with the recent dropping oil prices and a certain reduction in the oil consumption as well, where do you see that oil and gas sector going, and what impact will it have on the exchange rates? Because exchange rate is one good parameter that all of the economy industry looks at, because we are generally an import-based economy and the investments are also linked with that. How is your take on that?
I think in the short run, it's getting a little more widely accepted now that our forex rates are sustainable, and if at all they fall at an expected, sustained, consistent rate. Um, and the dollar, and Qasim will probably comment or elaborate that a little more. But it looks comfortable for now, and in the short run horizon or outlook, it looks reasonably comfortable. On the interest rate front, I think a lot gets driven by oil prices for us. It's a combination of oil prices and the rupee dollar parity for us, which then reflects into first and then subsequent rounds of inflation. That with the news flow that we hear that oil production, there's been capacity destruction at the fundamental level. So when I think, not that we see sharp demand rises, but it'll gradually start falling in place. And when it does, we'd have to see if the production side is keeping up the pace. So there may be volatility in oil prices earlier next year, perhaps, and about that time. And that's, of course, presuming that either we'll learn to manage the current scenario, get used to it, or are able to resolve it by, say, towards the end of this year. So on these presumptions, I would say in the early second quarter, there could be volatility in global oil prices, which would then have its effects on our inflation and subsequently interest rates as well once again. So we may go in the upcycle.
Okay. So Yasir Sahab, do we see the real remaining between the range of 95 to 100 for the next year, or do you see it's going above 100?
No, I think it's going to, it is going to inch up, and not at the pace that it would have because of, I guess, because what is happening globally. And if you look around, the most developed and the largest economies of the world have already announced stimulus packages ranging from 3 to 10, 11% of their GDPs. I mean, US is probably going to, their recent package is what? I think it's 11, 12% of their total public debt. So that's quite substantial. And so that's going to dilute the effect somewhat I think, for our currency as well. So it will not be as sharp as it could have been. But having said that, I think the real is going to rise, but it will not have probably a proportionate effect on the value of the rupee.
So, sir, essentially, we are still an agriculture-driven economy. Will our dependence upon agriculture will help us in coming back to normal much quicker than the other economies once this COVID-19 settles down? What's your expectation, sir?
So yeah, it's about 1/5 of our GDP. So saying that we are totally dependent on agriculture would not be totally correct. Having said that, it does, yes, dilute the impact. It enables us to sort of soft land. So to that extent, yes, our ability to bounce back, I would tend to sort of question that. And like I said, I'm going to break it up into two different parts. One, when the economy is going to come back on track for whatever it's worth, and how markets are going to react. So like I earlier shared my view that markets may react earlier if there are pockets of liquidity here and there available. Markets may sort of react to that positively, I mean. In terms of our economy, I think it's going to take a while. The good thing, however, is that on the tail end of all this we may be in a situation where we have a large fiscal deficit, challenging to be unmanageable. But in terms of, and I'm talking about incremental sort of relative terms, in terms of incremental numbers, the balance of payment may actually look somewhat better. So if at that time, the policy makers get their act together, we'll be in a position to change gears and get into the economic growth mode, we kind of have a platform, relative to the Pakistan economy, obviously. But let's say we are able to do that. I'm not so sure. I have my concerns on, the policymakers' ability to capitalize on that.
Okay. Sir, do you think that government packages coming shortly from the policy rate cut, payroll refinance schemes, and the export refinance limits that have been allocated to the industry to fuel the economy, what type of impact do you see during the next 1 to 2 quarters on that?
Ji Sajjad, as I shared with you earlier, that it's a total package of what, $1.5 trillion, 1.6, 1.7 trillion, 500, 550 of which billion rupees is incremental or additional, which wasn't already budgeted. So that is going to create liquidity in the system if we see it as a whole in the markets context. There are economic implications, if you want to break it up and go into that debate, but I think we'll refrain from that for now. So, so I see that as a positive. But having said that, there's this concern of currency in circulation, and most of the packages that we're announcing, if it is borrowing by the central bank, it will have a the proportion or the breakup of the M2 currently, I think it's not going to help the currency in circulation cause. It's not going to cause any reduction there because it will go into that or flow into that part of the economy. But having said that, it would have a positive impact on the system or the economy liquidity per se. So from that point of view, I see it will be marginally positive, but may not be sustainable.
Okay. Yeah, sir, with this note, I'll try to shift to the next panelist with Asim, because I'll get back to yourself later at a later stage as well, once we have some of views from the equity and fixed income experts as well, because your views will end up merging all the views of the other people, and we can spend hours discussing with you, and people enjoy hearing you on many accounts. So I'll move to Asim. Asim is our president for the CFA Society and is also heading as CIO of MCB Arif Habib. Asim, we have got Yasir Saab's views regarding the balance of payments, regarding exchange rate, and some of the view regarding the interest rate environment. So how do you see the equity market? I think you had a tough days during the last 1 to 2 months, but how do you look forward?
Good afternoon. Thank you, Sajjad, for inviting me here. I hope my voice is clear.
Yeah, very much audible.
Okay. So since you're asking about the market, a quick answer would be, I think, acknowledge the uncertainty that is prevailing in the short term. So very short term market is uncertain, but for long term, it's really a good market. If you allow me, I would like to just quickly mention about the context of overall environment, as Yasir Saab has already highlighted. So stock market cannot also be completely oblivious to this environment. We all recognize that economic environment is likely to remain uncertain and fragile risk to economic growth. In the short term, market will be highly responsive to the evolving scale of damage from the COVID to the domestic economy and how the world is moving. Throughout the world, the world's best strategists, capital market specialists, they all have linked the short-term market performance to how the situation evolves. So the question still remains the extent and the length of continuation of disruption in economic and business activities, both domestically and in the global context. Because again, it has implications for businesses, for public finances, as Yasir Saab mentioned. Pakistan mein we have a unique case in terms of overall impact. Hamare kuch indicators for the market positive hai. For instance, balance of payment position is likely to be positive along with liquidity plus disinflation that we have seen over the past few months and is likely to continue. And interest rates have come down by more than 5%. So these are positive. However, looking at the overall picture, the public debt, fiscal deficit, GDP growth, these indicators are facing substantial pressure along with employment and business profitability. So I think in the short term, we do not expect market to form the lows that we have seen earlier in the late March. However, in the short term, I think upside will also be limited and will follow the course as the economic situation evolves. Restaurant, we have seen risk aversion would also be high, and despite having higher liquidity, market will still look for tentative clues before it starts recovery. So individual sectors, if they are benefiting from this environment or continuing their earnings growth, they will continue to perform. However, I think the overall impact on the market is because of, again, the earnings growth, especially in the next year, where we are expecting about 10 to 15% drop in earnings. Usually we have seen that when a market drop, a significant market drop like this that we have seen, is followed by an impact on earnings, and recovery is also takes time. So in this case as well, I think market recovery will take some time. However, in terms of valuation, if you look at, we are standing 4 years back in terms of index levels. Valuations are decade lows since 2008 crisis. It's a काफी comparable evaluation. So which tells you that long-term upside potential is significantly higher.
So moving to what are the sectors that you expect that can benefit from the situation, like IT industry? There is complete like stay safe, stay home campaign is helping that IT industry. If we look at the construction industry, it has linked like 40 to 42 industries are linked to that. And there is a certain package that has a sort of an amnesty that has come into play. What about your takes on the banking sector that has been involved into these rate cuts? They have been part of the packages that have been offered to the industry. What is your take on these different 2 to 3 sectors? Who will be the strugglers and who will be the performers of the next 1 year at least?
I think we should recognize that until now, this is still short to medium term impact, and long term impact is still likely to be seen or evolve over a period of time. So talking about cement sector, where we have recently seen support from the government in terms of package, so news flow is positive. However, overall demand pressures will remain there as well. But with overall positive sentiments, I think cement prices may likely see somewhat upside movement, which can support the performance in the cement sector. Pharma, which has recently performed, I think, but going forward, except for the companies which are benefiting from COVID medicines and drugs, generally, I think the growth is not likely to be there significant. Similarly, E&P sector, oil and gas exploration sector is likely to follow oil prices, which for the time being looks like that they will continue their recovery and should support their performance. Similarly, power sector linked to energy chain, we are expecting government to issue energy support, which can improve the liquidity situation, particularly in the listed companies. So that can support their performance in the short term. While banks, I think, on short term, yes, there is uncertainty with regards to the overall interest rate trajectory and the incidence of non-performing loans or the credit quality of the loan portfolios. However, when we look at the banking sector valuations, even incorporating somewhat impact, personally, we do not see very significant room for interest rates to go down, barring the impact of COVID, if Khuda na khasta that extends to a significant impact. I think now the situation of NPLs would be a very important indicator. Having said that, valuations of banking sector PEs are now are multi-decade lows as well. So I think while underperforming, I think banking sector still deserve a favorable look with regards to allocation and investments because of the valuation.
So essentially, like we have seen an A curve into the interest rate, because if we look at like 2 to 3 years back when the interest rates were on lower side, many of the capital intensive industries have started their capexes, and then the interest rates gone up. So that has really impacted their earnings for the last year. So with these interest rates going down again, we would definitely look a certain EPS improvement into those sectors. Plus, will there be any liquidity that will be pumped into the market? Because we have always seen an inverse relation between an interest rate and the market activity. Now, will we be, do you think in the COVID-19 situation as well, market will attract some liquidity as a result of this interest rate cut?
These are the interest rate cut, to be honest, थोड़ा tricky है in this environment. In terms of liquidity, I think risk aversion would play a very important role in transitioning liquidity from riskless or less risky avenues towards equity market, which we are likely to see gradual or बहुत जल्दी नहीं होना चाहिए, थोड़ा slow over the period we would see that moving towards equity market. With regards to impact on sectors and market, on standalone basis, obviously interest rate cut is favorable for the valuations, for the market, for the company's earnings, especially those which are significantly levered. So all head constant, 1% cut in interest rate means our fair values increase from 3 to 5% range positively. However, I think in this context, because if you look at along with interest rate, there is risk of demand compression and margin compression as well. So in the macro context, what we look at, while lower interest rate means higher P's, which suggests that market would rise from here. The contrarian argument or the balancing factor is the overall economic performance as well. Since the GDP growth is likely to remain low, जो इस साल की negative है in real terms, next year we are expecting 2% plus. There will be risk to that. How would COVID perform, plus minus a few basis points? But a lower GDP growth also means your P should also remain in a lower range. So which factor I think will take more weight? I think will depend on confidence, and that is why I said that short term the market will be closely following the cues. Liquidity B system में है, but it will perform once थोड़ी सी clarity आनी शुरू होगी.
Okay. So coming back to the first point, like you have rightly mentioned certain packages coming into the industry to support the industry, and certain, for example, construction industry, and now the wheat prices support thing has also come into play. What do you think? Will it generate a certain amount of sectoral improvement that will help the investors to start considering these packages or market?
देखिए, although agriculture sector का support package B plus wheat support prices भी किसी हद तक I'm sure would be able to support the overall agriculture sector. We are likely to see relatively better performance in agriculture sector, and that can also impact the overall cement sector demand as well, along with the direct construction package that has been announced by the government. So these factors should support the overall demand in the cement sector. But given the overall overlay of lower economic growth, I think demand will still not grow that significantly. However, given the environment, I think this is still a better scenario, relatively a better scenario for cement sector. And this may, over the years, we have seen cement sector margins have compressed and they have come down. They have not been able to pass on prices. So in this environment, they may get some opportunity to pass on cement prices, and that can support the performance of overall cement sector.
So Asim, coming back to the last thing, like, yes, interest rates are dropping, and yet on the other hand, people are short of the investment avenues, the sustainable avenues, the unrisky ones. with the drop in interest rate, still people are interested to have a certain view into the secure investments, be these investments giving a return of 6 to 7% because of the risk associated with other markets like equity markets and the businesses as well. Do you see that the equity base will remain low because of this fear factor, lack of awareness? Are people watching for the secure type of things?
I think in my view, I think overall risk aversion does play a role. However, if you look at the market track record or market returns on long-term basis, they have been really impressive. So we did a study. I'm not sure if I can show that slide or not, but to 10-year period returns starting from 90s, they have been really impressive, double-digit, adjusted for inflation. They compensate well. Probably, I think, general perception about stock market as people continue to see as a short-term avenue to make money. And obviously, if you are caught in a wrong economic cycle, that can affect your overall returns. So I think probably people need to look at it as a long-term avenue because still, although our market hasn't delivered in terms of last 4 years, however, if you relate it to the overall economic situation, that is completely understandable. Plus, along with that, if you look at the 10-year performance period plus the last 4 years performance, this gives you more conviction that going forward 4 years, 5 years, 6 years returns or longer term returns would be significantly higher. So people have largely focused in gold and real estate. A real estate sector performance is likely to remain tentative. And largely only a few people could invest in real estate, but I think stock market is one avenue where generally if people look at from their long-term savings perspective, this could benefit the market as well, plus the individuals who are investing in. Plus I think stock market also has been lacking in terms of its breadth and listings. So we have seen several exciting businesses who are thriving even in this economy, for instance, the RAS, but they are missing from our local market. In fact, if you look at the US market recovery, it has mainly been supported by the e-commerce based platforms and the healthcare sector, which essentially is a very small segment in our market.
So I guess Qasim is with, and we will now shift to Qasim, seek his views. Like Qasim is a CFA, he's Chief Dealer and Group Head, Interbank Treasury for Elite Bank, and we see Qasim's view. So Qasim, are you available?
Yeah, I'm here with you. How are you? How is Sajad?
I'm just fine. Qasim, I can just recognize that people were making capital gains and losses into the equity markets, but the recent A-curve interest rate have made certain capital gains and losses into the fixed income market as well. So people were not that much familiar with making capital gains and losses into fixed income side, but now they have practically seen it for the past some time. What's your view on that?
Well, Sajad, as far as the gains and losses is concerned, I would say that the banking industry and the mutual fund industry is quite aware of that, because I guess that's their bread and butter. With regards to individual investors, well, they have probably seen such extraordinary moves for the first time, and industry as well has seen such extraordinary moves probably after 2008, I would say. And going back in a bit of a history, I mean, we were coming back from a very significant balance of payment crisis, which effectively led to this extraordinary increase in the interest rates since 2017 and 18. And rightly so, I guess the policymakers took the right moves because they had to give the shocks to the economy to bring the balance of payment to some sanity levels. And ultimately that fed into inflation, and forecasting that, they were ahead of the curve when they jacked up the interest rates. So we saw interest rates going from 575 basis points, and they went as high as 13.25. But I guess in all these markets, when interest rates are moving in either direction, markets tend to overreact a bit towards the end. Sometimes the peak goes beyond what it should have been, and sometimes the bottom goes lower than what it should be. So with the last hike that came around July last year, I guess market realized that inflation is no longer a concern. And balance of payment will also be quite a bit tamed down, depending upon how the central bank has been moving. And as a result, we saw the longer end of the yield curve tilting downwards gradually. Now, till that point in time, rather towards the end of 2019, a lot of market participants were forecasting 300 or 350 basis point rate cut over the course of next one calendar year, that is the calendar year 2020. And we had an interest rate shape, the yield curve shape, where it was going up in the beginning, and beyond 3 years, it was coming down. However, since January, beyond January, as the corona incident, it engulfed the entire world, and global demand and lockdowns, all of those things, they came into play. Everybody started feeling that it will have a major dent on the growth, and recession, all of a sudden, it became a big concern for our industry, for our economy, as well as for the global economies as well. So we saw across the globe, all the central banks, they came out all guns blazing, cutting interest rates. We saw emergency meetings, emergency rate cuts in the US. And I guess our central bank was also ahead of the curve again. They realized the kind of impact this thing will have on our economy, on our growth. And they were confident that we have been coming out of the balance of payment crisis, which most likely we will not go back into anytime soon. So with that confidence, they went ahead with extraordinary cuts, 525 basis points of interest rate cuts within a span of 2 months. I mean, I have been here in the industry since last, 18 years or so. I haven't seen. Ji Sajad.
Yeah. That is very much unprecedented. So one thing that everybody has a fear or an opportunistic about a thing, that how the interest rate environment would look like during Q1 of 2021. Because will it get a rise again, like it has seen a drop? Because somehow it's a factor of inflation with oil prices dropping down, but at the same time there is a fear that food inflation will may come into play, because once this lockdown is over. What's your take on the interest rate outlook for the Q1 2021, if you can reflect a bit?
Okay, so if I recap a bit, I guess we have seen inverted yield curves in Pakistan as well, probably once or twice in the past, but this was probably the longest running inverted yield curve we have seen, and Asim and Yasser will agree with that. I mean, we haven't seen such a massive inversion, and it basically started off as inflation expectations. They started to be a bit more comfortable, and adding to that, the corona incident, it further dampened the inflation expectations, and the growth, it became a major concern for everyone. However, with I guess the major chunk of the interest rate cuts have gone through now, and we have started seeing that the yield curve is trying to come back to its normal shape. We can see another 50 or 100 basis point cut going forward. I guess central bank would want to have some arsenal in their pocket, given in case of any untoward incidents with regards to the COVID-19 situation. We can have a second round of corona internationally as well as domestically, so they would want some arsenal in their cannon, so that which they can fire later on. However, I believe that the major portion of the cuts have gone through. We can see another 50 or 100 basis point going forward. Yield curve would probably be, now the longer end would start tilting upwards with the target rate as the anchor, which is the 8%. So we would see a normal shape, and it will start developing, I guess, in the coming months or so. So having said that, I think if I am investing right now, my bet would be on 1 to 1.5 year of durations. And if I have to enhance my yield pickup, then I would probably mix 4 or 5 year with a 3 month instrument and try and balance out the duration bit and have some yield on in my portfolio as well. Ji Sajad.
Qasim, in recent times, we have seen a certain portfolio investment coming into our sovereign debt markets and then going out. How do you see it, this phenomena recurring again, considering this interest rate environment that we are going through?
And thanks for not using the word hot money, because it's been used, I guess, quite a lot now. Well, Sajad, I guess we have interest rate differentialism is the primary driver of such portfolio investments. And we have seen interest rate differential of 12% or 13% in past as well. However, I guess nobody was able to successfully market Pakistan with regards to a fixed income investment heaven, I would say. So, and this government and the central bank as well, I guess they played a key role. They partnered with the market participants, they partnered with Bloomberg and Reuters and everyone, and they were able to pitch a good case for Pakistan being a destination for such investments. And hence we saw that as the confidence of the international investors got built up over a period of last 1.5 and 2 years, they saw how we have tackled our balance of payment issues and the fiscal consolidation was on course. So we saw roughly $2.5–3 billion of portfolio investments in this industry. And I guess everybody at that time was expecting this number to go probably up to $6 or $7 billion, which is not extraordinary given we have a good track record in terms of an investment country. However, nobody was anticipating COVID-19 to happen. And when that happened, we saw portfolio outflows, because I guess under such circumstances, investors generally they have a risk off sentiment, and we were not the only economy or the only country which experienced that. Across the emerging markets, we saw funds going out, we saw investors pulling out their money towards the safe havens, and that is what happened with us as well. So in a span of probably a month or so, we saw $2.5 billion of these investments going out, and our currency depreciated by almost 7.5–8%. Again, not extraordinary given what we have seen in other emerging markets where currencies have taken a battering of 10 and 12%. So we've done reasonably well. Plus, I would say that international investors, for them, profit and loss is one aspect, but ease of exit is another aspect. So when they were able to exit their investments in a smooth manner, I guess this must have given them a lot of confidence. And we have discussed it as well with a couple of participants. And I hope that as soon as the risk-on sentiment comes back into the markets internationally, with the kind of monetary easing internationally has been happening and with zero rates everywhere, I guess it is going to be a very, very yield-hungry world. And we are still offering phenomenal returns, whether in the equity markets or in the fixed income markets. I mean, 8.5% of unhedged return we have right now, which is not bad. I mean, and even if we talk about a return. Sajid, am I with you?
Yes, very much with us. Coming to the last point, since you have rightly pointed out, like capital gains and losses in fixed income market is very much familiar in the financial services industry. But now the individuals who still feel that fixed income is still a secure and a market from them which they want to consider. So it's very much relevant for them whether what do they want to keep the duration of their fixed income portfolios as short ones or a long ones, invest into 5-year PIB or 1 to 2 years. So what's your recommendation for such investors, particularly the investors who are looking, individuals who are looking into the direct fixed income instruments, who are policy holders in an insurance company or a mutual fund investors?
Sajad, I would say that given that the major portion of the interest rates curve have materialize. That is what we believe. And based upon our view, if we start things turning around, economies are opening up, our economy is also opening up. And with the kind of stimuluses we have also given, and so there is going to be a bit of a liquidity overhang in the economy. Probably we would start witnessing that next quarter or the quarter after that. And there has been a lot, there will be a dent on the fiscal side as well. So we expect fiscal deficit to touch maybe around 10% for this fiscal year, and the next year's number is also not very promising. So I would say that investors should be a little wary of the longer duration instruments and try to restrict themselves to 2 to 3 year instruments at best. And probably by next year, this time, given that the corona thing eases down, we would see a slight rebound in the yields. So probably restricting themselves to up to 2 year instruments and then locking in at that time will be a better idea instead of going for 5 years or beyond.
So thank you very much, Qasim. Let me give you an example. What happened to an individual investors who have already invested into fixed income instruments. I'll give you an example of IGI Life. It's their IGI Secure Fund. They have made a return of 7.5% during the first 4 months of the year. If you can see on your slide, like 7.5% during the first 4 months of the year in a fixed income market, and it's an absolute return, not an annualized return. So you can see how the durations come into play. Like, must be policy holders are enjoying that 7.5% return that have been generated in 4 months time. Yes, moving forward, they may be having a 0.5% return per month and ended up at a year of around 10-11%. But that is how the fixed income portfolio market is now interesting. What's your views on that?
Yes, Sajjad, can you hear me?
Yes, I can hear you.
Yeah, well, I would say 7.5% over a 4 month period is definitely phenomenal return. And but as I was saying that I guess you've done pretty well. I would say, I mean, this is a very decent return given that it's a relatively safer portion of the market. I mean, fixed income is not known to give you returns that beat inflation. So you're beating inflation, so that is wonderful. I would say that going forward, if that bonanza is now more or less over, so 0.5% every month is not bad going forward. If you add that on top of what you have already done, you would end up very well. I mean, this is really commendable.
So let's see what the investment team can have for their policy holders in the balance of the year. Qasim, thank you very much for your time. And with this, the first session of our panel discussion is over. Now we have a certain product endorsements, which I'll quickly run through because we are short of time. And then we'll take the question answer sessions with our panelists, because I have seen a lot of questions coming in. That means a lot of interest that people have shown into this. So I'll quickly go through the product endorsements. And number one, like this thing is sponsored by IGI Holdings. They have a subsidiary, IGI Life. They have their Takaful plans. They have their conventional plans. They have offerings into the life side, accident and health insurance and saving plans. They have this product called Vitality that is a game changer into Pakistan industry. I guess our agency team and the banker team is online. They are familiar with these products. They can be accessed for the briefings about the plans. The online knowledge tools are available in terms of the fund management report that is available on the website on a monthly basis. Plus, there is a tax break that is available to an investment into an insurance company or a mutual fund company, and that is up to 20%. And since June is approaching, many individuals, particularly salaried individuals, are focusing on to their tax planning. so they can save up to 20% of their taxes by investing into a life insurance plan or a mutual fund plan. So Asim, any views of yourself regarding that tax saving that the individuals can do, yes, legally as per the tax laws before their 30th of June?
So yes, I think this environment mein, overall importance of saving has been significantly highlighted, especially people who do not have savings to bank on in these testing times are now facing the brunt. So this highlights obviously everyone needs to look at savings, and I'm sure globally we experts believe now savings trend. In fact, in China, it has been observed that the nation has resorted towards higher savings in general. So we already have support from the government in terms of tax benefit towards higher savings. So rather than generally, when we look at savings, they should be more long term rather than the inducement to just make money or invest for a very short period. To be able to double or triple your investment is not obviously the objective. So rather look at it from a long term perspective and avail the tax benefit that government has announced, which again adds back to your return. Even if you earn zero return, that means you have 20% return in terms of tax benefit over the next period the government has announced.
Thank you very much, Asim. So if anyone wants detail of this, they can always catch up on the website address that is given. They can call online into these addresses and get connected with the relevant people for any briefing on that. There is a questionnaire around this tax break that is available on the website of IGI Life as well. One can easily see that. So the other arm of IGI Holdings is IGI General. It's a general insurance company that deals with property insurance, auto insurance, travel insurance, and home care. So its products can also be accessed through their websites. So that is a briefing about IGI General, IGI Life. And that's if any individual has a certain preference for a brokerage thing, we have IGI Securities available. People can access their research reports are frequently published and are available that are being used across industry. So that is a brief about our product announcements regarding various plans that we are offering. Now, I'll quickly move to the last session. To our panelists, we have quite a large number of persons, and I'll start off with the first question with Yasir Saab. Sir, very pertinent one. Unemployment in the coming periods. Mr. Yusuf Raza has requested, how do you see the employment or unemployment rate moving forward given the economic situation post this lockdown, because a lot of the businesses does not have the financial muscle to stand onto their leg post that lockdown situation, and how this unemployment situation will move and how it will impact the economy?
I think it's I mean, one can of course say unemployment is and will probably continue to be on the rise for the next few months. Giving a more specific answer, of course, is a bit of a challenge. A lot of these things are taking a view on the pandemic itself, because that will have direct implications. And the panelists today are certainly not experts on that, and even people who are experts on that are having a hard time, taking a specific view on that. So hence, just putting my finger on anything specific would be a challenge. But yes, it is on the downtrend, unfortunately, and for now that trend looks like it's going to sustain for some time.
Okay, so coming to Asim sir, $1,000 question. How do you see auto industry performing?
Yeah, auto industry, obviously, when you are talking about so much uncertainty in the environment, so much destruction in terms of overall economic progression. Our overall levels of personal incomes are likely to take a hit. So in that environment, auto sector being a more durable sector, which requires, again, which naturally has a high correlation with overall GDP growth, may not perform well. Having said that, I think we have to recognize for the last 3 years, we have been facing through a very challenging economic growth phase. So other than developed markets, which were mostly in expansionary phase, for them, it does came as a huge shock. So for this sector, I believe relative to rest of world, I'm sure एकदम steep drop should not be there. Third drop hoga, but given already we have been at low levels for the last 2-3 years, even last year, I think usse zyada significant depression should not be there. In terms of margins, it looks like a stable environment, plus there are supportive factors as well. I think in the very short term, for the next few months may not be good, but gradually it is likely to pick up.
So coming to Qasim Saab, this question here, Mr. Rana Nadeem has asked that question, and he has asked that question specifically from yourself, Qasim Nadeem Saab. He wants, as a banker, what's your take on the exchange rate during the next 2 quarters?
Next 2 quarters. Well, I recall once a question on exchange rate was put to Alan Greenspan, and he said it's like a toss of it's like a toss of coin. I mean, you can't say which side it will turn up. But I guess we saw the parity under pressure over last 2-3 months. That was primarily on account of the portfolio outflows that we witnessed from the local fixed income market, and the bulk of that has now gone out. The fundamental problem that we had with the currency over last 2-3 years, I guess we have that under control pretty well. Balance of payment is now pretty much even. We have seen 1 or 2 months with probably a balanced balance of payment. So going forward as well, with import compression and with the terms of trade tilting slightly towards our favor, I would say, given the prices of edible oil and the crude oil as well. So we will have some benefit on that, but it will be slightly negated as well by the compression on the export side, and the evolving situation in the MENA region, which will have some impact on the employment and ultimately on the home remittances that we receive. So I would say that by and large, it will be sort of a balanced kind of a situation. And we should not be seeing an adverse movement by more than 1.5 or 2% at max. And the current levels are pretty much, I guess, in line in terms of the fundamentals as well, because as I said, that the balance of payment is now under control. Inflation for the time being is not an issue. So for next 1 quarter and 2 quarters, I would say we are pretty much at the level where we should be. 1.5 to 2% depreciation we can see, given any extraordinary demand that may come up. And I guess the central bank has done a tremendous job by leaving the currency and the market forces. And so pretty much if there is any pressure, it gets evened out in the medium term. So I would say that we are comfortable at the level of 160, 161 to a dollar.
Thank you very much. So in the interest of time, we'll take this final question, and that is from Ms. Rabia. She wants, what is the risk of hyperinflation post-COVID-19 into Pakistan economy? And is there any risk of negative interest rates in Pakistan? Yasir Saab, would you like to share your thoughts?
That is too radical a question for my taste, but no, we've never seen negative. To the best of my knowledge, we've never seen negative interest rates in Pakistan, and the structural flaws we have, it's not very likely But never say never with economics. We've been surprised in the past, so one never knows. But it's highly, highly unlikely. And the other extent, hyperinflation. Yeah, we've been through those cycles earlier. This is not the time to be expecting such a scenario in the foreseeable future. However, like I said, it is a very vulnerable economy. Things tend to change very, very rapidly. So having an outlook which goes sort of deeper into the future is always a bit of a challenge. So, I mean, to put it in a nutshell, both these scenarios are not very likely to happen in the foreseeable future.
Thank you, Yasser. So, Asim Saab, one thing that is relevant to the commodity system, is gold a good investment as of now? Someone has asked that recommendation as well, whether to invest in commodities like gold at this stage. Though it's not a financial market, but still that a question has been asked and wanted to run it through you.
I'm not an expert on gold. However, strategically speaking, what we have seen how gold is being taken and in the portfolio allocation around the globe is as a diversification tool, and sort of again in risky environments you can bank on this asset to be able to support you. So globally it is seen as a diversification hedging instrument, because gold, especially in high risk environment, can perform well. But generally, if you look at the features of gold, doesn't pay you any earnings, doesn't pay you any dividend. It doesn't fit that criteria. However, since it's a real asset which has its worth, and this is probably the best time where its worth is really tested. So it does have a place in the portfolio, and investors should have. That's why it is usually recommended that gold also reduces the overall riskiness and volatility of the portfolio. So it does have a place. However, I would advise do not put all your eggs in one basket. So have some allocation to gold, some allocation towards fixed income instruments, and if your risk and time horizon allows, then towards equities as well.
Sir, thank you very much. There are a lot of questions, but we can only take a few. I think on each of these things, be it fixed income, be it economy, or be it equity market, we can have separate sessions, and each session may last for 2 hours, and still there will be a lot of questions that will be coming up. With this, I would like to thank all of our panelists for sparing some time for this session, for serving the policy holders and the general community with your piece of advice into such challenging time. It's really a contribution from your side to the investment market of the industry. And thank you for taking out time from your busy schedules. With this, I would like to sign off from my side and over to Noman. Noman, over to you.
Thank you so much, Ji. Once again, from IGI Holdings perspective, a special thanks to all the panelists, Mr. Yasser, Mr. Asim, and Mr. Qasim. And thank you so much, Sajjad, for moderating this very, very interesting and insightful session for all of us. As I noted in the beginning of this session, this is an ongoing effort that IGI Holding is taking on board. This was a second in the series of the webinars that we have held. We will be holding many more, in the coming weeks. And I would just request, the audience to join for all the sessions, that we run. We have seen a huge uptake of attendees today. Really surprised, but very pleasantly surprised. So thank you so much, all of you who have attended and taken time out. And a special thank you goes out to my team, without whom we couldn't have actually had this session organized in such a professional manner. So thank you so much, Usman Khalil, Jahangir Nazar, and Madiha, to have helped us set up these sessions. Once again, I appreciate all the panelists for their time. And on this particular note, we would like to sign off till the next session. One more thing before we go. The recordings of this session and the PowerPoint presentations of these sessions will be available just after the session online, as well as through various medias. So even if you have joined at a later stage during the session, don't worry. These will be available for you to have a look at. Thank you so much, and have a great day.